What's up guys, today we're going to talk about technical analysis again, and on the part 2 I'm going to talk more about how to combine two candlestick patterns together or more so that you can use that to increase your profit and minimize your risk. Alright, so let's get into that. Why is it so important for you to read candlesticks? It's because it gives you an indication of these three things, okay? An indecision of the market. So if you see that the market is going through a ranging consolidation market, this is what I mean by indecision or whipsaw action. Or if the market is trending, it's going to reverse, then it gives you an indication of price reversal. Or the market is trending and it might continue to trend, okay? So it gives you an idea on whether the trend will continue or not. And why do we use candlesticks? Because it gives you an idea of what the markets are feeling right now. In other words, market sentiment during that particular trading time. Now you by now already know that a lot of the indicators are lagging indicators, so it will only give you the signal once the market has reacted, and candlestick would be able to give you an earlier signal whether traders are feeling optimistic or pessimistic right now, okay? So it serves as a leading indicator, which is a good thing, but that doesn't mean that you need to use candlesticks alone. Of course, you need a lot more indicators. Aside from using candlesticks, you need to use it as a confirmation alongside other indicators, okay? So here comes the question, how do you read and use candlesticks? In order for you to read candlesticks properly, you need to look at two things, okay? Two things. The first thing is your candle body. Second thing is your candle wick or candle shadow. Now if you're still not sure what a candle body is, what candle shadow is, go to my beginner's guide to candlesticks video, then you can familiarize yourself with all these terms. And then when you spot a candlestick signal, you need to see whether this candlestick an uptrend or a downtrend, in a bullish market or is it in a bearish market, okay? So you need to know that. One very important thing, don't use candlestick alone as an entry and exit signal. You need a lot more indicators for you to confirm that you can enter this trade. Now with that said, there are some people who use it for exit. If it works for you, then fine. There's no black and white when it comes to indicators. If you don't use it to exit, you can use it to scale up or reduce your position size. Whatever works for you. And you use it as an early warning for potential change in direction. And when the market does change in direction and when it does reverse, we don't know how long will that reversal take, okay? So we use it with other indicators to determine the duration of the reversal. So basically you use candlestick to determine whether there's going to be a reversal later on or not, or whether the trend that you're trading at right now will continue its movement. Another question that I get is, where should you use candlesticks? You can use these patterns not only for forex, you can also use it for stocks, commodities, if you're also trading, investing in all these asset classes. Okay, so the first type of candlestick pattern is the Doji and spinning top pattern. Now what's the difference between these two? So you can see right here for the Doji. Now Doji means in Japanese same price level, okay? Why do they say it's the same price level? It's because the price opens here, and at the end of the hour, at the end of the period, it closes at the same level here. An ideal Doji is one that has a negligible body, okay? It's just a line just like that, okay? And then it has a upper wick and lower wick that is equal length to each other. So spinning top has a small body, and then same thing with the upper wick and lower wick with the same length, ideally. So the two similar things about these two candlestick patterns is that the price closes near or right at the open price. And these two types of candlestick patterns can be seen both in a bullish and also bearish market. So for the Doji, when the price opens right here, during this whole entire period, buyers come in, push the price up. Then after that, sellers come in, push the price all the way down. Then after that, buyers come back again. So Doji in a way is a tug of war between the buyers and sellers. And hence this indicates that the buyers and sellers, they are indecisive and uncertain. Same thing for spinning top. Of course, we need a lot more indicators for you to say that the price would reverse. So in a way, what Doji and spinning top indicates to you is that the market will potentially reverse from here. That's what it means when you see a Doji and spinning top. Now here's the thing. Now if I'm to compare two dojis together, okay, let me try to draw this nicely. If I'm to compare these two dojis, okay, which one do you think is stronger, the one on the left or the one on the right? Now if you see a doji with a longer wick, now you see this very often when there's a market news event, a significant high impact news event, economic announcements. You see a very volatile, a very big candle, okay? When you see a very long wick, a lower and upper wick, this is a stronger signal as compared to if the doji has a smaller lower and upper wick. Because a long wick indicates to you that the markets are very indecisive, meaning that the larger the doji, fiercer is the battle between the buyers and the sellers. And another thing that I want to compare is the length of the lower and upper wick. If you see that the length of the lower and upper wick are not equal to each other, then this wouldn't be as strong as compared to if the doji has equal length lower and upper wicks. Now I need to remind you one very important thing, okay? Even though doji and spinning top signals a reversal, a market reversal, it wouldn't tell you how long the reversal will last. It might last for 5 minutes, might last for 1 hour, might last for the whole entire month. Now how do you determine how long that reversal will last? You need to add in other indicators for you to determine how long will the reversal last. Doji and spinning top only give you an indication that a reversal is coming. Okay, so let me give you an example. So you can see this whole entire chart right here. Can you spot where the doji is? Now it doesn't have to be the perfect ideal doji. So first thing first, you can see one over here, and you can see another one over here. Okay, this one is not the ideal doji that I'm looking for, but then you see the price goes bullish. Okay, right after that, buyers and sellers are indecisive. Eventually a doji appears, then the market reverses. But of course, a reminder to you again, we don't rely on candlestick patterns alone to determine whether a price would reverse. You need a lot more indicators. If you use support resistance, then you might see a potential resistance over here, okay? Or maybe you use volume. You see the market is oversold, then eventually the price retraces. And use this as a additional confirmation. Okay, another example. Right now, can you see where the doji is? See one over here, and then you see another one over here. Now here's the thing, this occurrence here is a double doji. So when you see a double doji, it's an indication, okay, an indication or prediction that the reversal would be stronger as compared to if you are to see just one doji. So another candlestick pattern that I will share with you is the hammer. First thing first, you realize that hammer has a very small body on top, okay, and then it has a wick that ideally is 2 times longer than the body. So essentially what's happening is the sellers first come in and push the price all the way down, and then the buyers start to come in from there, and then preventing the price from going further downwards. Then eventually they push the price up and then closes on top. Now bear in mind that the color of the hammer body doesn't really matter, but if you see a white candle or a green candle, it has a higher probability where it's going to reverse and go bullish, okay? So to sum it up, when you see a small top body with a long lower wick, then this is a hammer. Now whether you can have an upper wick or not, ideally not. So what the hammer signals to you is, it indicates that the price would potentially reverse. And the only place that you can find it is downtrend markets. So let me give you an example, okay? So can you spot the hammer real quick? Okay, ignore the dojis for now. Spot the hammer right now. Can you see it? Okay, let me just show you where is it. Right here. Okay, so market is going downtrend initially, okay, and all of a sudden a hammer appears, and only in a couple of hours on the next day, then the price reverse. So realize this one phase over here. What can you conclude from this is that the price doesn't reverse immediately. Doesn't mean that when you see a hammer right here, oh, then the price immediately, the next thing you know, it reverses. Sometimes it might take a couple of days, sometimes it might take a couple of hours, because the market would need time to adjust itself. So that's another reason again we don't use candlestick patterns alone to enter. If it works for you, then fine. There's no black and white in trading, there's no one size fit all in trading. But to be safe, I think it's just better to use a lot more filters, a lot more indicators. With that said, don't go and clutter your whole day chart with all the indicators under the sun. Do it in moderation, okay? Not too little, not too many indicators. Another type of candlestick pattern is the inverted hammer. As the name suggests, inverted is basically upside down version of the hammer. So you see a very long upper wick right now, and then a small body at the bottom. So the buyers start to come in, and then once it reaches this point, the sellers start to come in and then push the price down, prevent the price from going upwards. Then there's a tug of war going on again. So the sellers push the price down, and then eventually the price closes here. So for the inverted hammer, you see a small lower body and long upper wick as a result of that. So what does it indicate? It also indicates a potential price reversal. Again, same thing, you see that in a downtrend market. So meaning that you have a downtrend market going on, you see an inverted hammer. It is a signal that the price would potentially reverse and go bullish. Again, one very important thing, it doesn't happen immediately. Sometimes it might take weeks, sometimes it takes a couple of hours, sometimes a couple of minutes. So let me give you an example. So see right here is a downtrend market, okay, and then after that the price consolidates a bit, ranges a bit, then you see an inverted hammer over here. Okay, this isn't that ideal because I would like the body to be a little bit smaller, but that said, this is an indication that the price would reverse. So after the price ranges for a little bit, eventually it went all the way, changes the trend and go bullish. So another candlestick pattern is the hanging man, which is very similar to hammer. Now you see this box that I put here is green color, just now was red color. It has a meaning, alright? It means that you can find it in bullish markets. Just now when I put it red color, it means that you can only find them in bearish markets. So if you want to take note of that, you can go back to the video and then write that down. So one thing you see about the hanging man is that it looks very similar to hammer pattern, and again same thing, it indicates to you that the price would potentially reverse, change in direction. And like I said, you can find the hanging man in the uptrend market. Ideally the body has to be 2 times longer than the body, but if it doesn't, then it's still okay. The signal wouldn't be as strong. So this is where the hanging man is. So you can see the price go bullish, then after that the hanging man appears, then eventually the price retraces. Okay, very likely there's a resistance line over here, and this is an area of resistance. Okay, so there are 2 signals just based on this chart that the price would reverse. Another pattern, final one, is the shooting star. And then again you realize that it is very similar to the inverted hammer pattern. Same thing, indicates that the price would potentially reverse, and then it's found in the uptrend markets. So do you realize something? Okay, based on what I've talked to you just now until right now, I know you're confused about, oh, what's shooting star, hammer, on all these names. To put it simply, whenever you see this pattern, okay, this has to be longer. This pattern, or this pattern, it's just telling you that things are gonna change direction. So one thing to bear in mind is that the longer is the wick as compared to the body, then the stronger the signal. Meaning that this shooting star would be stronger as compared to this shooting star. Okay, because the wick is shorter. Let me give you an example. Can you find the shooting star? Once again, okay, an obvious one right here. So of course this reversal is not that significant because you see the price go bearish a little bit over here. Okay, then after that the shooting star appears, then eventually it went a major bullish movement. Okay, so let me just pull up this chart right here. Based on what you've learned, can you spot where the candlestick patterns are? Here they see just right off the bat, you see a doji over here. In fact, a lot of signals over here. Okay, you see a shooting star over here. Even though it has a small upper wick, it's still okay. And then you see a spinning top over here. So this area right here is a very strong signal for a potential price reversal. So see another spinning top over here too. The price is going on a bullish market right here. Then right after that, you see what happens? A major reversal. Meaning that by this time right here, you need to really get out if you are in a buy trade. Another indication that the price would reverse, that wouldn't break off this level over here, okay, is that there's a resistance right here. I drew this based on 10th of April. Okay, and then the price tested this level multiple times before it retraced. Came down and then it tested for 50 SMA, then came back up here, tested the resistance line one more time. Okay, another example over here. First thing first, this is a downtrend market. See the double doji over here. So the market moves a little bit, then eventually, after a couple of hours, then it retrace, make a major reversal. Then right after that, you see a hammer appearing right here. So the market goes back to bullish a little bit, then eventually hammer appears, then immediately it retraces. But remember, this doesn't happen all the time. Then right after that, you see a spinning top over here. Okay, this one is not that ideal because the length of the upper wick and lower wick is not the same. But you can see that after this spinning top appears, then the price goes on a bullish movement right here. Alright, another example, you can see a bearish movement here. A very large spinning top. Then immediately the price eventually retraces. So if you really zoom out, that's why the price came down, tested one time, tested second time, before it reverses. Okay, so you can see based on this chart over here, you see a small spinning top over here and you see a bigger one over here. Which one do you think would give you a stronger signal? For now, ignore all the other indicator signals first. You can see that after this spinning top appear, it reversed only a little bit. Of course, many other factors can come to play. You need to look at sentiment, you need to look at fundamentals. So you can see that this spinning top right here, it caused a major reversal. Look at that. Okay? Moreover, it is an instant reversal. So by the time you see this and this appearing, especially if you're a day trader, you need to prepare to get out, because you might be potentially caught in this movement even though you are trading in a bullish market. So right here you see a hanging man right over here. Okay, you're trading in a bearish market, and then some people consider this as a shooting star, so we take that too. So you can see that the market is going in a downtrend, then eventually the market goes bullish immediately. There's another thing, again, you can see that there is a support over here. Market comes down, tests this level one time, after that goes up, tested 50 SMA, then comes down again, tested this level again, then eventually bounce back up. So if you're riding this movement right here, be sure to get out. Once you see a shooting star, once you see the hanging man, it's time to get out from your sell trade. To be safe, okay, add more indicators, add more filters. Because candlestick alone is not enough. May I remind you that again. So one last example, okay, you see that over here, there's an inverted hammer, okay? And then right here, you have a very small, can be a potential doji or spinning top. You can see a major bearish movement before this. Right after these two candles appear, if you're in a sell trade, if you're riding this whole entire trend, okay, you need to get ready to get out, because right after that, reverse, which is enough to kill a lot of traders. So if you're using candlestick for your trading, let me know down in the comment section below. How does candlestick patterns help you in your trading? And which pattern is your favorite candlestick pattern? I'm Careful, and I'll talk to you in the next episode. Bye.